Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. In finance today, making decisions when outcomes are uncertain is something everyone faces, whether you're an investor or a business manager. A key tool for tackling this challenge is the Capital Asset Pricing Model, or CAPM. This model helps us understand the relationship between risk and expected return by focusing on systematic risk, which is risk tied to the overall market. At the heart of CAPM is a measure called beta, which shows how sensitive an asset is to market changes. Knowing how to calculate and use beta helps businesses and investors figure out the return they should expect from their investments, whether that's stocks, projects, or portfolios. While CAPM isn't without its critics, it remains a fundamental part of corporate finance and investment analysis. In this presentation, we'll break down CAPM, walk through beta calculations in detail, show how businesses apply it, look at real-life examples, and weigh the pros and cons of using this model. The graph here illustrates how CAPM evaluates whether assets are overvalued or undervalued based on where they sit relative to the expected market return and their beta, helping guide smarter investment choices. Capital Asset Pricing Model, or CAPM, was developed in the 1960s by Sharp, Lintner, and Mossin to explain how expected returns relate to risk in an efficient market. The model uses a graph called the securities market line, which shows expected returns on the vertical axis and beta, a measure of risk, on the horizontal axis. The line starts at the risk-free rate and slopes upward, reflecting higher returns for higher risk. The formula for CAPM calculates an asset's expected return by adding the risk-free rate to the product of its beta and the market risk premium, which is the expected market return minus the risk-free rate. According to this model, investors are compensated for the time value of money and for taking on systematic risk, which is captured by beta. Unsystematic risk, or firm-specific risk, is considered diversifiable and not rewarded. Beta measures how sensitive an asset's returns are compared to the market. A beta of 1 means it moves with the market. Greater than 1 means it's more volatile. Less than 1 means it's less volatile. And a negative beta means it moves opposite the market. This helps investors understand the risk profile of different assets relative to overall market movements. Technology stock might have a beta of 1.5, while a utility stock might have a beta of 0.6. Beta measures systematic risk, which means risk related to broad market factors like economic growth, interest rates, inflation, and geopolitical events. These factors impact all companies and can't be removed by diversification. Beta is calculated using a statistical formula that compares the returns of the asset with the returns of the overall market. Specifically, it's the covariance of the asset's returns and the market's returns divided by the variance of the market's returns. This shows how closely the asset's price moves with market changes. To calculate beta step by step, you first gather historical price data for both the stock and a market index, like the S&P 500, using consistent intervals such as monthly or weekly data. This process helps investors understand how sensitive an asset is to market risk. To calculate beta, we start by finding the returns, which is the change in price from one period to the next divided by the earlier price. Then we compute the covariance, which helps us understand how two sets of returns move in relation to each other. Next, we calculate the market variance, which measures the overall volatility of the market returns. Beta is found by dividing the covariance by the market variance. In practice, beta is commonly estimated using linear regression, where the stock's return is expressed as a function of the market return plus an error term. The slope of this regression line gives us beta, while the intercept, known as alpha, represents the stock's abnormal return. Financial platforms like Bloomberg, Yahoo Finance, and Refinitiv typically use this regression approach to estimate beta. CAPM plays a key role in business by helping estimate the cost of equity, which is crucial for discounted cash flow valuations, capital budgeting, and calculating the weighted average cost of capital. The cost of equity from CAPM feeds directly into the WACC formula, which balances the costs of equity and debt according to their proportions in a company's capital structure, factoring in the corporate tax rate. When companies evaluate new projects, they need to adjust for risk, and CAPM helps with this by assigning higher discount rates to riskier projects and lower rates to more stable ones, like comparing a low beta utility upgrade versus a high beta biotech research project. Additionally, CAPM is useful for performance evaluation, such as calculating Jensen's alpha, which measures a portfolio's return. Alpha measures how much a stock outperforms or underperforms compared to its expected return after adjusting for market risk. A positive alpha means the stock delivered better returns than predicted by the model. For example, when valuing a public company, if the risk-free rate is 3%, the expected market return is 9%, and the company's beta is 1.2%, the expected return would be 10.2%. This rate is used as the cost of equity in valuations when comparing stocks. A utility firm with a beta of 0.5% generally has lower expected returns and risk, while a tech firm with a beta of 1.6% higher risk and potential returns. So investors with lower risk tolerance might choose utility stocks, where CAPM has several advantages that make it useful despite its criticisms. First, it offers a simple and clear way to understand the relationship between risk and expected return, focusing specifically on systematic risk, which investors cannot eliminate through diversification. It is widely accepted in practice and used by investment banks, corporate finance teams, regulators, and academics, providing a common language across different users. Another benefit is its consistency, since it sets a standardized framework to compare different investments easily. However, CAPM also has notable limitations. It relies on assumptions like perfect markets, no transaction costs, and fully rational. The capital asset pricing model focuses on systematic risk through beta. It doesn't account for other important sources of risk like size effects, value premiums, or momentum, which led to the creation of multi-factor models, such as the Fama-French model. Additionally, CAPM relies on inputs like market returns and the risk-free rate, which are estimated rather than exact figures, presenting challenges in precise calculations. Despite these limitations, CAPM remains a key tool in finance because it links expected returns to market risk in a clear and logical way. It's especially useful for businesses to estimate the cost of equity, make investment decisions, and evaluate performance, while investors use it to understand risk and construct portfolios. Even though newer models have been developed, CAPM continues to be valuable as a common framework that helps us understand the relationship between risk and return, making it an essential part of financial decision-making. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.